Thanks, Eric, and like Eric mentioned, thanks, Keith. He's been a great supporter of ours and invited us to this, and also thank everybody for listening to our story here. So, advisory. So, Granite is an organic growth plus a sustainable dividend model, and I'll throw in even at $45 oil. What sets us apart is our asset. It's very unique in how we've developed it. We've got 100% owned Bakken oil property. There's a large original oil in place, 480 million barrels from a Sproul report. What's very important here is a lot of this oil is conventional, so you're going to hear that throughout this presentation, which is very, very unique. Less than 1% recovery to date. There's no competitive drainage, so we set the pace of development. We're not pressured to overcapitalize or anything like that. Again, very important in our industry. Started gas injection, enhanced oil recovery early. So about a year after we found the core of the pool, we converted our best oil well to a gas injector. 2 years later, we had 3 injectors, and now 3 years later, we've got 6 injectors re-injecting all of our Bakken gas. So it's we like to say that even though we're a small company, we're the Imperial Oil and Suncor of small properties here. We really took care of this thing. A very large infill drilling inventory. So basically, we have a large conventional oil pool here. It's under an effective EOR scheme, and we have many years of high-impact infill drilling. It's a very good recipe for this model. So, this is the asset. The best way to describe this thing is it's big. We've delineated an 80-section oil pool here. It's 29 miles tip to tip. And what I do want to stress here too is everything you see in this map we own 100%. It's very unique. It's a real testament to the team we've had to put all this together in a short time. You can see the discovery in 2011, and then we continued delineation right through to today. We've got an 8,000 barrel a day oil battery, 200 kilometers of infrastructure. There's 350,000 net acres of Bakken rights here. All the heavy lifting's done here. And I will point out to our drilling inventory here. So you can see how we've delineated this pool. That's with the black wells, and there's a ton of infill drilling here. So a lot of the gravy's ahead of us. There's a lot of heavy lifting's been done here. Okay, so a big part of our story here is, again, it's a conventional oil pool. It's under gas re-injection, which is it's something that's kind of new with the elevated gas prices in the past. It's become a little bit more popular here. We kind of started this thing here, and basically we're just re-injecting gas into the reservoir to maintain voidage and provide pressure support for the oil producers. Again, this is proven technology. We like to say it's not a unicorn. It's been effectively used in Alberta. There's been about 25 of them in the past, and a lot around the world where you don't have access to a gas market or pipelines. So, all our data and performance to date suggested that this is the best thing for our pool. First thing is just simple pressure maintenance. All we're doing is we're making sure all that gas goes back into the formation. Any oil we take out, we make up with gas and just keep that pressure constant, to just keep that drive in the reservoir. And the second thing here is very important. This is an undersaturated reservoir. We've never found a gas cap. So what that means is actually we can put more gas into the oil and it'll get absorbed in solution and stay as a single phase, and which is increase the drive through the rock. And the third thing is high CO2 content of our gas, 25-28%. Again, CO2 swells the oil, helps drive it through the rock. I know a lot of people in our business, Weyburn is one of the big success stories in Western Canada for a recovery in an oil pool through Missinnovus, and that's a CO2 gas flood. Because gas floods haven't been that prevalent in recent years, everybody asks us for analogy. Everybody knows about water floods. So first of all here, before we show you how well it's working in our pool, we're going to show you an example of a pool here and how effective it can be. So this is the Alaska Swanson River pool. Again, it's undersaturated, similar in size to ours, 435 million barrels. So the history of this thing is found in 1957. In 1962, they started a pilot, had success. By 1966, they were at full-scale gas injection. In 47 years, they recovered 230 million barrels, which is 53% recovery, so it's tremendous recovery. Now, what I'm just going to point out here is the front of the curve here, and this is kind of the holy grail of our business with a DivCo here, with a conventional pool, is literally you see after they ramped up their gas injection for 12 years, this oil pool did not decline with no new wells drilled. You're making up full 100% voidage. It's a conventional pool. There can be literally no decline. So again, this is what we're rapidly targeting, and as Eric mentioned, increasing the dividend. A lot of that had to do with our shallowing our declines and being ahead of our EOR scheme. Two parts to this. The first part is we're able to shallow the declines or basically recover on old wells. So this is just a graph of the center of the pool here. Pretty self-explanatory. There's about 3 injectors here, 3 of the original injectors. About 20 wells, and you can see when we ramp up injection, and the red line there and the green line, we just hockey stick the oil production. So we're taking care of the old wells with our ramp up of injection. Second thing is initial well declines. So this is an example. Now, if anybody knows the history of DeeThree or Granite in this pool, we announced some of the biggest wells through the years in Alberta. We've announced several wells that, again, this is conventional horizontal wells that flow 1,000 barrels a day. In the old model, we turn these things on, they'd flow for a week. And go into this decline, just no pressure maintenance. Go forward now, what the plan is, we still get these same wells, we go into the center of the pool because we've looked after it, drill a well like it was the first well in the pool, still get these high initial flow rates, but now what we do is we pinch them back, ramp up injection and nearby injection, keep that voidage up, and these wells flow. And you can see the difference. We're even doing better than this now, I'll get to that, but you can see the difference of a well outside the injector, terminal decline. We're taking care of it now, we've shallowed its decline, but then you see an initial well. These are big wells, like that's almost a year of production on that EOR supported one, and it's still over 100 barrels a day. So these are big material wells. The new wells that we're drilling in the scheme now, we've got several here. Been flowing at 300 barrels a day, one for 5 months. Again, as long as we're maintaining that pressure, we're not losing it, they continue to flow like they were producing day one. So we put it all together here. You can see the base that we're just shallowing the decline here, and now what we're doing is we're drilling wells, we're pinching it back, making up injection, and we can grow our production very efficiently and very rapidly. So we put it all together. Very simple process. We take the oil and gas out of the reservoir on the bottom producing wells, run it through processing equipment, oil goes to sales, gas goes to high pressure injection, and just back into the top of the reservoir with into other wells. In the future here, we actually have our own gas plant. We're going to actually start stripping out the C5 plus when the NGL prices recover a little bit, and that's a little bit of a bonus right now. We're just putting it back in the reservoir. So one thing is we do re-inject all of our gas, and we still have to make makeup gas to account for the oil voidage. So this is an old Encana shallow gas property, lots of uphole gas, so we've got a lot of gas available to us to make up for that growth in the oil production. Optimized drilling, I mean, this thing in the core is over 40 feet thick. So we think horizontal technology is going to increase this gas injection recovery. So very simple. If you can think of it, we're just putting gas in 4 floors up, distributing that gas in the top. What isn't getting absorbed by the oil is staying up there by the laws of gravity. And then with our horizontal wells on the bottom, we're just siphoning oil off the bottom. It's very, very, very effective. So, we have a lot of flexibility in this model. We get this with our effective EOR, capital efficient drilling, like on an IP 365, we're less than $15,000 a barrel. Our debt is very good. We're less than 1 times debt to cash flow. We can do a lot of things here. This is just a 3-year business plan with $45 oil for this year, and then $60 oil, and then $70 oil into 2017. We're still growing 10 to 15% a year. We're paying the dividend that we're paying now, 39 cents a year. But what happens here, this property just creates more free cash flow. So there's 2 options here. We can actually grow faster, or we can actually increase the dividends, even at these low oil prices. And we stress tested this right down to 45 for years to come here. You say we're very confident of our dividend. And so really the pool is going to tell us this. This is a very technical property. Like you say, we like to say we're like Imperial Oil looking after this thing. We're going to get the most oil out of the ground, and we're going to do it the most efficient way we can. So the pool will tell us how we want to increase the production. So we'll take that free cash flow. It's either going to go out to a dividend or else we're going to increase growth. So again, we're in a pretty good position here, even with these depressed oil prices. So anyway, I'd like to thank everybody. John and I are outside of the table for the rest of the day. And again, thank you everybody for listening.